Hi, welcome back to Wesbury 101. I'm Brian Wesbury, Chief Economist at First Trust Portfolios. We're headquartered in Wheaton, Illinois. And remember, we want to be the antidote to conventional wisdom. Well, Happy New Year. Happy 2010. It's great to see you again. It's been a little while, and I just wanted to do an outlook today for the year 2010, tell you what we're looking for in terms of economic data. And I guess the place to start is that we believe the V-shaped recovery is still underway, that we are growing strongly, about 5% real growth in the fourth quarter of 2009 when it's finally reported in a couple of weeks. And then we suspect we're going to have about 4.5% real growth during 2010. Now, we might have some bouncing quarters. Once you get a 5% rebound in the fourth quarter, you might get a little payback, 3.5 in the first. But on average, we expect 4.5% real growth during 2010. By the way, what that does with productivity, it translates into very good earnings for the stock market. And we have now rerun our capitalized profits models. And what we are showing is that if you use today's 10-year Treasury, remember what we do is we go get the data on corporate profits from the government. And those reported corporate profits are the company's profits that are reported to the IRS. In other words, I don't know anyone who reports profits to the IRS that are not real because they have to pay taxes on that. That costs money. And so these are the most conservative estimates of profits that you can find. And we take that measure of corporate profits and then we divide it by the 10-year Treasury yield to create an index of capitalized profits. Then what we do is we compare that index to the stock market over time, looking at every single quarter back over 50 years to determine if the market is undervalued or overvalued today. What we come up with is using a 3.8% 10-year Treasury yield that the market is 80 to 90% undervalued today. In other words, if we were to apply our model to the Dow, we would forecast about a 19,000 level on the Dow as being the appropriate fair value level. Now, before you turn this video off and think I'm crazy, remember, this is using a 3.8% 10-year Treasury yield. That's excessively low. We believe there is a bubble in the Treasury market today. So what we do is we put in a 5% yield so that we're even more conservative with our approach. And when we do that, what we come up with is a fair value of 14,000 or 14,500 roughly in the Dow this year. And our forecast for 2010 is 13,000. Now remember, we expect 20 to 30% growth in corporate profits this year. The consensus is for about 20%. We believe we could exceed that very easily. And this is important because if interest rates were to go up even further than our estimate of 5%, let's say they went up to 7%, the 10-year Treasury went up to 7%, almost doubling from where they are. What that would do to our model is it would say that the Dow and the S&P today, right now, are fairly valued. And then you would have growth in corporate earnings on top of that, which means even if the 10-year Treasury went to 7%, the stock market should continue to go up. So remember, our forecast for this year is that we get to about 13,000 on the Dow Jones Industrial Average by the end of 2010. Call that 1325 on the S&P. So right now we remain very bullish, looking for 20% plus gains in the stock market again for 2010. Now, this is interesting because many people are worried about Fed rate hikes, and we suspect that the Federal Reserve will raise interest rates. Our first rate hike is this year in June of 2010. Now, it won't be an official rate hike because right now the Federal Reserve is holding the federal funds rate in a range between 0 and 0.25 roughly in the middle, about 0.1%. We think they will allow the interest rate at first in June to drift up to the top to a quarter, and then they're going to start raising interest rates later on in the year. So in our Wall Street Journal submission, where we had to forecast for December 31st, 2010, we have a 1.75% federal funds rate. In the middle of the year, it's 0.25. At the end of the year, it's another 150 basis points higher at 1.75. We have the 10-year Treasury moving to about 4.5% at mid-year and then 5% at the end of the year. Along with this is an inflationary boost. We think the CPI, the overall consumer price index, will increase to about 3.5% inflation by the end of 2010. That's one of the reasons that interest rates will be going up. The other one being that the Federal Reserve will begin to lift interest rates. Just a quick comment on the yield curve right now. It is extremely wide, and what it's telling us is that the Federal Reserve is holding interest rates too low. I kind of look at the federal funds rate like an anchor. And then the yield curve as the chain or the boat line, and then the long bond as the boat. And what's happening now is that the anchor is firmly stuck down at zero at the bottom of the sea. The anchor line is holding on the boat, and there are gale force winds, if you will, stretching that yield curve to its maximum length. One of two things is going to happen to this year. Either the Federal Reserve is going to lift the anchor and allow the whole yield curve to float up. That's what we believe will happen. Or if the Federal Reserve continues to hold the federal funds rate at zero, I believe that it could be very easy for that anchor chain to break and the long bond and the spreads between long bonds and the federal funds rate to go to all-time record highs. One of those two things is going to happen. Our belief is that the Federal Reserve will relent in the face of very strong economic growth, in the face of rising inflation. They're going to be pushing interest rates up. Commodity prices will also rise. We're going to see a rebound in the housing market, the first good year in housing we've had in many, many. And so 2010 looks like a lot like 2009, except now the economy will be firing on all cylinders instead of just a few. So have a great new year. Happy trading. And remember, we want to be the antidote to conventional wisdom. See you next time.